Welcome back, you legends. I'm Dr. Cal. I'm going to try to run through this as fast as possible. It's 2 a.m. my time and I need to catch some Z's. So let's get right into it, guys. The stock market today is basically flat, right? The S&P is down 0.2%, the NASDAQ 0.2% in the green, and the Dow is down 0.4%. Let's take a look at the different sectors. Leading the day was energy, followed by basic materials, technology, and cyclicals. So we're seeing a bit of a risk on day underlying the flatness of the day. And then the laggards were utilities and consumer defensives as well as real estate. So the most defensive sectors in the stock market were in the red today, and the most offensive sectors, including energy, tech, and cyclicals, were in the green. Let's take a look at the stock market map. A bit of a mixed bag today, right? We're seeing energy green, some cyclicals like Tesla in the green, but Amazon is in the red. Some big cap tech companies like Microsoft, Google, and Meta in the red, and some tech like Apple, Nvidia, and AMD in the green. So it's a bit of a mixed bag today, guys. It doesn't really tell us much, but there's something very interesting going on, and I want to start out with the daily chart for the S&P 500. Now, when I saw that gap up today on the open, I did warn everybody in the trading community that please be careful. This is a trap, and it was very obvious. In fact, half an hour before the market opened, I did warn, guys, the market wants you to believe that this is a repeat of the June low island reversal with a gap up today. Wrong. Before the market bottomed in June, the HYG smart money had already been rallying for 2 consecutive days. What's the state of the HYG now? A waterfall sell-off. The smart money simply did not confirm this reversal at all. Now, this is what the HYG looked like when we made that June low on June 16th. Look at this. We had already been rallying for 2 days. This was the first day where we closed green, another day that we closed green, and then we had that June 16th low. This is what the S&P 500 was doing back then. Look at this. This is where we bottomed on the S&P 500. Look at this. June 17th. The market was still selling off. We had sold off the day before. And on the 2-hour chart, we were actually making a double bottom with a lower low on the price action and a slightly higher low on the PPO. Look at this. This was the bullish divergence, very obvious bullish divergence, right? We had this gap down and the PPO made a higher low. Now, before we made that bottom on June 17th, the HYG had already been rallying. And on June 17th, look at this, June 16th, June 17th, we made higher lows. So we had a divergence, a very bullish divergence where the smart money was making higher lows as the S&P 500 was making lower lows. Does this look like this to you? Absolutely not. We're still making new lows on the HYG. There is no bullish divergence forming. The DXY, the dollar index, is still shooting up. Yields are still shooting up. The VIX, the fear index, the volatility index, still shooting up. Really nothing indicating that this is the bottom. If you're bottom hunting, you have to be very patient. Wait for these divergences. Wait for the VIX to start to cool down. Wait for the dollar and for the 10-year yield to start to cool down. If we see those cool down and then we start to see the HYG making higher lows, at that point, I'll be waiting for the S&P to make somewhat of a bullish divergence. And at that point, I'll be ready to say that we've bottomed, but we haven't bottomed quite yet. Now, again, guys, this is what the trading room looks like. It's $20 a month, and I do share every single trade and investment that I make in real time. I also share technical analysis, daily technical analysis on the S&P 500, my trade ideas, my investment ideas, my weekly watch list with price targets, and specific fundamental events, product launches. I also share member exclusive videos, and there are a bunch of more rooms here that you don't see where members of the community can share ideas, discuss different news events, different economic data, as well as a dedicated room for Q&A, question and answers, where I answer everybody's question. If you're interested, guys, it's $20 a month, and it's the best way to support me and the best way to track my trading activity, my trading style, my technical analysis, and all of that good stuff. If you're interested, please check out the link in the description below. Now look at this, guys. We've had 3 days of consolidation, but in my opinion, we've had 3 days of distribution. Now the difference between consolidation and distribution, guys, is both technical structures basically happen when we have sideways movement in the stock market, where the price action is not moving up or down, it's just moving sideways. Now, in consolidation, when we consolidate, when we move sideways for a few days and then break to the upside, we call that consolidation. We see buying in this consolidation. In distribution, we see the opposite. We see sideways movement with selling, controlled selling that leads to a break to the downside. Now, the reason I'm saying that this is distribution is very interesting. Number one, we're seeing consecutive lower lows on the closing basis as well as on the intraday basis. Right? This was the close last Friday. This was the intraday low. This was the close Monday. This was the intraday low, slightly lower both. This was the close today, and this was the intraday low. So moving lower on heavy distribution selling volume. This volume here in these red days is notably higher, very much so higher than any green days in the last couple of weeks. And so we're seeing controlled selling. Now, we did have this descending wedge pattern. This is a bullish pattern that usually breaks to the upside, just like what we had back here when we had a break above this resistance line. We had a nice counter trend rally. Yesterday, we had a break above this resistance line, but we had a failed rally with a tombstone candle. Today, guys, we made an even lower low than yesterday. The histogram on the PPO on the momentum is continuing to show weakness with larger and larger red bars. On the smaller time frames, guys, on the 1 hour chart, we did have a nice double bottom formation with a slightly higher low on the PPO. Now we have a triple bottom formation with an even higher low on the PPO. So we do have a bullish divergence, but I do not trust this divergence at all. I don't believe in this divergence at all, and it has to do with this, everybody. Our trusty HYG, our trusty smart money chart. The smart money has been putting in consecutive lower lows with bearish momentum accelerating to the downside. Really, we do not have any support on the high yield bonds until we hit pandemic lows of 68.6. That's still a ways off from here, and unfortunately it just means more weakness into the SPY. This indicator, guys, usually leads the S&P 500. So as soon as we broke below the June lows back here, I immediately said that we will take out the June lows with the S&P 500. Now, officially yesterday, we did take out the June lows for the S&P 500 after we closed at $364 below the lowest close of June, which was 365.8. We made a new low today, and we will continue to make new lows, in my opinion, simply because the smart money is saying new lows are coming. These small bullish divergences in these smaller time frames are nowhere near enough of a bullish indicator for me to go long, especially with the HYG saying new lows and with the VIX entering really nasty, horrible, terrifying territory. The red line that you see here, guys, is Hell's Gate. Okay, this is Hell's Gate. We haven't closed above this resistance line ever in any of these sell-offs. Year to date, we've never closed above this red line. We haven't even closed above this black line until a couple of days ago. So this sell-off is different. It's not like any of the sell-offs that we've seen year to date. This is something way more sinister. We're now knocking on Hell's Gate. As soon as we close above 33 on the VIX, really all hell will break loose. So we have the HYG warning of more pain, the smart money warning more pain is coming. We have volatility, the fear index, the VIX warning more pain is coming. And We have the dollar index. Look at this, guys. Yesterday, we closed above this resistance line in this ascending channel. Today, again, we opened in the red and we closed in the green, again outside of this ascending channel. This, in my opinion, is now trying to form a blow-off top-like formation for the dollar. And that will likely, guys, very likely take us up to 120 on the DXY to revisit the 2002 highs. So now we have the HYG, the VIX, and the dollar index all warning more pain is coming. This is completely different from every sell-off we've seen this year. This is different from the July sell-off, different from the June sell-off, different from the May and April sell-off, different from the March sell-off. This is completely different. We're now entering the final stage of this collapse. We're now officially entering that end stage collapse phase. The VIX is indicating that, the dollar index is indicating that, and the HYG breaking the June lows indicates that as well. And on top of that, we have the 10-year yield making a year-to-date high. Nearly every day for the past week, we've been making year-to-date highs. And we haven't yet even gotten to 4%. And remember, guys, the Fed is now projecting a terminal rate by the end of next year of 4.6%, up from 3.8 in the prior meeting. And this terminal rate will continue to go up. In my opinion, this terminal rate will go up to 5% by the next meeting, cranking up rates even higher, pushing down valuations even lower, especially in high valuation names like pretty much everything in the triple Qs, the NASDAQ. Now let's jump into the daily chart for the NASDAQ, guys, and same thing really that we're seeing with the S&P, we're seeing with the NASDAQ. The NASDAQ is still trying to hang on after we broke out of this descending wedge, but we haven't seen any relief rallies like we've seen back in early September. Momentum is just so much weaker right now than it was in early September, if you can believe that. And I still think the triple Qs will go down at least to $255 to the retracement level, the 38% retracement level on the Fibonacci zones. Now, guys, this Fibonacci retracement level is actually based on the 2009 low and the 2021 high. So this is a very long-term Fibonacci retracement level that I'm looking at, and we're now really just a spitting distance away, and the chart just looks so weak, and I really have no doubt now that we will retrace back to 255 to this Fibonacci retracement level and to the bottom of this consolidation zone. I also have another downside target that takes us all the way down to $235 to revisit the pre-pandemic highs and touch this support line. This support line, guys, held for years. It held back here in 2016. It held in 2018. It held in 2020. And I suspect it will hold again this year and next year as well. And to move all the way down to this support line, guys, will take us back all the way to retest the pre-pandemic highs. Now let's take a look at gold, guys. Gold hates high yields and hates a strong dollar. And we're seeing that reflected in the significant weakness that we've seen in gold. Gold, in my opinion, will continue to sell off all the way down to the mid 140s and will likely form again that bullish divergence that I've been waiting for, with the PPO making a higher low and the price action, the daily price action, making a new low, a lower low. That, in my opinion, will create a beautiful, beautiful bullish divergence, and that will happen as soon as the dollar makes that blow off top hitting 120. After we do that, it is very obvious to me that smart money will flow out of the dollar and into gold as the next safety play. Now let's take a look at Tesla, guys. This is the daily chart for Tesla, and Tesla continues to show weakness. Yesterday I talked about this triple top formation with a significant negative divergence, with the PPO putting in consecutive lower highs on the daily chart, as Tesla has been putting in consecutive equal highs on the price action. As soon as we break 270 on Tesla, I expect a waterfall sell-off to take us all the way down to $225 to fulfill this full measured move on this bearish structure, which would take us right on the dot to $225 to revisit this low back in July. I continue to be bearish on Tesla, and I continue to hold my extremely aggressive short position using 2 put butterflies on Tesla, each costing $500 and each netting over $5,000 to $10,000 if this trade goes my way. If it doesn't, this $500 will go to zero, but I'm risking $500 to make 1,000 to 2,000%, and that's a risk I'm willing to take. Let's take a look at Apple. Again, Apple continues to try and hold on to these support levels here around $150. And again, just like Tesla, it is just waiting for a break below 149, and that will trigger a waterfall sell-off. A full measured move again on something like this will take us down all the way to $125 to take out this low right here. Now let's take a look at the percent of stocks above their 200-day moving average. And remember, guys, I did talk about this indicator in the middle of August, warning that we will see a new sell-off that will take out the June lows. And unfortunately, it just looks really bad, right? It looks very bad. This is the percent of stocks above their 200-day moving average. We're now back at the June lows in terms of the percent of stocks above their 200-day moving average. And unfortunately, guys, I do not see any way that this will hold these levels. This indicator will have to move significantly down from here. The dollar index is predicting it, the smart money HYG index is predicting it, and the VIX is predicting it. On top of that, we've actually made a brand new low on the PPO. So momentum is now officially more bearish than it was back here in June. And there's no chance for this now to form a bullish divergence. We've simply taken out the prior lows on the PPO on the daily chart. And so a new low, in my opinion, has no choice but to be made very, very soon. Now, if we track this indicator, guys, going back to 2008, I want to show you something very interesting. We went down to the same levels that we've seen in the June low back in March of 2008. Then we rallied to the same levels that we've seen in the August high this year, back in May of 2008. And when we broke down, that was it. That was it. This was the last major bear market rally in the bear market. After that, we had this very weak bear market rally, and then the market had that waterfall sell-off. This orange line is the S&P 500. I just added it to show you what it looks like. And look at this. This was a very, very anemic bear market rally that we had after the last major bear market rally in 2008. And it failed. And at this level, guys, we had that rejection of the 125-day moving average. Exactly the same way we had this rejection of the 125-day moving average earlier this month. And I warned that every single time we had this rejection, the market had massive, massive sell-offs follow, anywhere between 10%, which we've already broken, and all the way down to 20%. And 20% would take us to $330, which is just above my low-end target of $325 to retest these lows in this consolidation zone right here back in October of 2020. So now let's take a look at the S&P 500 today and compare it to this look that we had in 2008. Let's just take a look at what we have here and just look at that. It looks almost identical, right? We had this rejection at the 125-day moving average. We had the same rejection of the 40% line in terms of these stocks above their 200-day moving average. Just look at this, guys. We're rejecting off the exact same level that we rejected back in 2008. We had that rejection in mid-August where I warned something sinister was brewing. We're going to take out the June lows. We really had all of those indicators warning that something very bad is happening. We had the rejection of the 200-day moving average here. And then we had that rejection of the 125-day moving average just a month later here. And now we're making a new low on the percent of stocks above the 200-day moving average. And we're now making a new low on the S&P 500. And we will likely have 10% more selling from this point on in the S&P 500. Now let's take a look at seasonality, guys. And again, midterm seasonality is very bad in September and October. And then in November, December, we tend to have that nice holiday rally. And so we might see some anemic attempts at a counter trend rally towards the beginning of October into mid-October. And then we'll have that one last waterfall sell-off that takes us down to that $325 level on the S&P 500. Let's take a look at the fear and greed reading. We're now at 17. We continue to make new extreme fear readings, and I still expect us to hit zero within the next 4 to 5 trading weeks. Market momentum continues to fall off a cliff. Stock price strength continuing to fall off a cliff. Stock price breadth continues to fall off a cliff. Put to call ratio making a new high today, and it is forming a bit of an ascending wedge, which could indicate that a relief rally might come. But simply, guys, the technicals are just too weak for that to happen. The HYG, the dollar index, the yields, the VIX all indicate more pain is coming. And then we have market volatility. Again, the VIX that I talked about, we're now sitting above 30 for 2 consecutive days. Really nothing good happens in the stock market when the VIX is at 30. And not only are we at 30, we closed above this resistance line, this black line. This red line is the last line in the sand that separates us from all hell breaking loose. We're now just 1 point away from opening the gates of hell. In terms of the economic events tomorrow, guys, we do have a bunch of economic events. We do have more Fed speakers coming out, Fed Chair Powell, Bullard, and Bostic speaking. We also have a lot of sales numbers, retail inventories, wholesale inventories, goods trade balance, a lot of data coming out tomorrow. More Fed speakers, Bowman and Evans speaking as well. And we also have the Treasury note auctions. Thursday, we'll have jobs numbers and the GDP revision, more Fed speakers. And Friday, we'll have the dreaded PCE inflation figure. So really, there's nothing bullish this week to drive us up all the way into that PCE inflation figure on Friday. Now, if this figure comes out hotter than expected, expect a precipitous, very aggressive, very nasty sell-off. If this PCE inflation figure comes in below expectations, we could expect a very aggressive counter trend rally to the upside. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one.
Oh, wow. Wow.